Welcome to Business Talk here on businesstech.co.za. The world of exchange-traded funds has come a long way from its passive origins, and now 91 is adding a new chapter to that story, launching two actively managed ETFs on the JSE. We've got the 91 Diversified Income Prescient Feeder actively managed ETF, and the 91 Global Diversified Income Prescient Feeder AM ETF. It's a milestone that really speaks to how far innovation in investment structures has come, and perhaps where the next wave of investor demand is heading. Well, joining me now to unpack this development is Trinisha Chanka, Sales Manager at 91. Trinisha, welcome. A very exciting week for you and the team at 91. You've listed these two actively managed exchange-traded funds. Your entry into the ETF market is very interesting. Why are you entering the ETF space now, and what are you seeing happening in the industry globally that has led to this development?
So thank you, Michael. I mean, I can't actually stop smiling because it's such a surreal event yesterday to list the first of our many to come actively managed ETFs on the JSE. Really exciting to visit, experience the heartbeat of the South African economy. And the reason why we're entering the ETF market is because globally, the market is now more than $17 trillion US. It's expected to grow fast. It's growing at around 20% per year. And so it's expected to get to $25 trillion US by 2030. And what's interesting about the growth is just how that growth is happening. So half of all the ETF launches last year were actually in active strategies. And I think that, drive has come from a few things. There's been changes in regulations around the globe, including the JSE, where actively managed ETFs are now allowed on the exchanges. In the past, the ETFs had to track an index, so it wasn't possible to actually deviate from the index. Now that regulation has changed, that's opened up this environment for innovation. But more importantly, I think what is driving, this adoption of ETFs around the world is the investors themselves. So investors are now demanding real-time access. They want to access investment thinking via digital solutions, like they do things for the rest of their lives. We've got apps for banking, we've got apps for shopping, and so there's no reason why we shouldn't be able to do that in the palms of our hands with respect to our investing. And the active management industry now really allows investors to experience the best of both worlds: the agility and the insights of active management, plus the liquidity and the efficiencies of listed trading.
Yeah, and that's why I think it's such an exciting time, because to your earlier point, you said it's probably the first of many that are going to come to the South African market. And that's a fantastic thing. If you see how much we're spending on things like online gambling, just frightening. But if we make it easier for investors, if we reduce the friction, if you can do it in the palm of your hand through a smartphone, for example, then you start to break down the barriers and you democratize access to investing even more. And I think it's the most powerful way to compound wealth over time. Everything else, all the studies show that. But maybe let's go back a little bit, because I think it's important to distinguish between a traditional ETF, as you said, something that maybe just tracked an index, quite vanilla, versus these new actively managed ETFs. What's different? And what would you say is really driving the rise of a more actively managed type strategy?
So, Michael, as you rightly say, the industry started its roots. The ETF industry started in, passive types of products. That's where the index provider will basically give you a list of shares or constituents to buy. They'll tell you in what proportions you need to buy that. And, that will give you access to a broad market. So if you think about the JSE, you might have a top 40 index where you then get exposure to the top 40 shares on the JSE in the proportions of their weightings that the index provider has set. The beauty of active management, and I say that because our core belief has been that we want to deliver long-term investment results through active management. And we believe it's possible that you can earn enhanced returns by not holding this index tracking portfolio, but rather using research-led, thoughtful investing to pick, shares from possibly a wider opportunity set, and then based on your research, decide how much you want to invest in each share, which is not dictated by the index that you are benchmarked against. We believe that research can add value. It can help you be in the right companies at the right time. So you're picking quality investments. It also then helps you to right size your portfolio. And if you think about, as an example, global equities at the moment, the S&P 500 index, if you are in an ETF that is tracking that index and you bought it because you want global equity exposure, you currently are overly exposed to a single country. It's dominated by the US. A lot of the exposure is within the AI theme. And the top 10 shares in that index are almost 40% of the index. So you're taking huge concentration risk. Markets and the world is shifting faster than ever before. And an active manager can help you avoid those concentration risks. If they can help you, right size your portfolio so you end up with still a global equity portfolio that is now more risk aware, less concentrated, and importantly, able to shift as markets are shifting and things are changing. And you will know better anyone that 2020, we say this every year. We say things are happening faster than ever before. And then, the next year rolls around and, there's another big event, there's another geopolitical situation, there's another Trump and another Liberation Day or another tariffs. And so as an active manager, we are able to build a portfolio that is robust and is, adapting to changes in the markets and ultimately seeking to outperform, because if you deliver 2, 3, 4% alpha per year over a 20 or 30-year time horizon, that is significant.
Oh, yeah. Yeah, that is massive. I mean, that is transformative to anyone's personal wealth journey and ultimately what we're all looking for. And I agree with you. The old saying was, the more things change, the more they stay the same. I don't think it could be more wrong for today's world. The more things change, the faster they change every single year, and that tends to just compound on itself. But what's changed in the South African market to support this evolution from a regulatory perspective? Because it's just been really over the last sort of 12 to 18 months that we're starting to see this rise of actively managed ETFs.
So I spoke about the regulations that have changed. That's obviously been a big, requirement to open up the environment for actively managed ETFs. As at the 30th of September, there was 284 products listed on the exchange-traded products. More than 100 of those are actively managed, and they've all come to market in the last 2 or 3 years since the regulations have changed. A lot of that, for the initial period has been driven largely by managers like ourselves wanting to make our active expertise available, on the JSE. And that has been driven, by wanting to make that active expertise available to a wider range of investors. So the reason we're coming to market, and I suspect the reason most of my peers are coming to market, is because traditionally we've served investors and offered our investment strategies within a unit trust format context. And that typically requires investors to buy it on a platform. Now that investors are becoming more digitally savvy, with the rise of ETF platforms and online share trading becoming more accessible through the likes of Easy Equities and like Standard Bank Online Trading or ETFSA, it's now possible to actually do that investing yourself. And you can do that now via JSE. So it's really, we are indifferent to whether investors access our strategies in unit trust format or on exchange. We really want to meet the investors where they are. And therefore, we want our products to be available through multiple platforms so that it's ultimately up to the investor what works for them and what's easy for them. And hopefully that will then, lift the savings culture in this country, and get more people to join us in the markets.
Exactly. And that's why it's so exciting. Again, whether or not you've got a shared trading account with your bank or you go through easy equities, as you say, or whatever your platform is, it's really, you've got to be agnostic. I think in all distribution models in the world today, and we see Checkers 60/60, for example. I mean, you can go in store, most people are now shopping online. You've got to meet people where they are in a digital first world. Tell us about these two actively managed ETFs that you're going to be listing, because I think it's a very interesting time to be listing products in the fixed income space, just given how well we've seen South African bonds perform this year. And again, following the budget, some more good news. What role do you see them playing in portfolios?
So, Michael, we're listing two actively managed ETFs. We're starting with our diversified income strategy and our global diversified income strategy. If you're looking for them on the exchange, they're under the 91D Inc. ticker or the 91G Inc. tickers. And they are both income solutions. They are multi-asset income solutions. The first one is based on predominantly South African assets. So we will invest across South African cash, South African bonds, SA credit, offshore bonds, property, and we'll manage our currency positions. So really talking to the full range of fixed income asset classes that are available. The global diversified strategy is similar in nature in that it's diversified across US dollar cash, the full suite of developed market bonds, in the entire range of emerging market bonds, and high quality offshore credit. And these strategies are ideally suited for investors who are sitting on cash. You might have taken profits given where the markets have run. Both global equities and SA is at a phenomenal run with respect to platinum and gold is lifting our market. So there's a lot of investors that might be sitting in cash and waiting to be into the market. They're probably sitting in either bank accounts or within their stockbroking accounts on cash, and they're earning 6.5%. The SA fund really offers you close to 9% yield, so a significant pickup. The US dollar strategy, it's on exchange, we're trading in rands, but that strategy feeds directly into our US dollar fund. And there we're targeting US dollar cash. So you're ultimately targeting about 1.5% to 2% above SA and US dollar cash rates, respectively. And what that means is you can really sweat that cash that you're sitting on and make it work harder for you. And that is why, that's where these products are really focused. I saw an interesting stat the other day. The Reserve Bank usually publishes the amount of money that sits across the banks within household deposits. So this is not all the deposits. This is just the ones that are in respect of households holding money in their bank accounts for 6 months or longer. And it was 450 billion rand that is sitting in there. And that is really, when your money is just standing still and sitting in cash accounts, you are really losing value because inflation, you're not even meeting your inflation. So your money's not staying, you're maintaining its purchasing power. And we'd really encourage investors that are sitting in those retail bank deposits or in cash in your stockbroking account, consider these funds. Your cash can work harder for you. You're not giving up any, you're not taking any substantial additional risk. Our funds at their core are structured so that we've got a focus on capital preservation. So you're earning more, you're earning 1.5% to 2% more than the STEFI benchmark or the overnight US dollar benchmark. And those benchmark rates are typically higher than what you're actually earning in your bank account. So you could be 2 to 3% actually better off by sitting in these actively managed ETFs. And the proof is in the pudding.
And you've got liquidity.
We've got liquidity. These are well-established, trusted strategies. We've been running them for years. They've been relied upon by financial advisors, institutional clients. We've got proper scale in these strategies. So you can look at the track records and you can see, and the proof is in the pudding because in COVID, we had 3 months of negative, we did not experience a consecutive 3 months of drawdowns, which will just demonstrate that was the real stress test, right? That was a real life test of, are we say we're preserving capital, we say we've got to focus on that. Are we actually doing it? And in that period, we did not have 3 consecutive months of negative returns. We've never had a negative month on our global diversified income strategy. So as an investor, that should give you comfort that, capital preservation is really at the heart of what we do and how we manage these strategies.
Yeah, I was having a look at it's managed by 91's global fixed income and credit team. So you're talking over 70 odd professionals, almost 400 billion that they're overseeing. I mean, that should really give you great comfort that the top people are looking at these strategies, looking after your capital. And I agree with you, just where we are in the market. You look at Warren Buffett, and Berkshire Hathaway has never sat on so much cash before. Valuations look extremely stressed and stretched in the US. We've had a fantastic run on the JSE. So, yeah, rather than have that money just idle in a bank account, this makes absolute sense to me. Maybe let's just finish off with exactly how an investor goes and accesses these actively managed ETFs, the 91D Inc. and the 91G Inc. How do they go about it?
Thanks, Michael. We want to make investment access to our investment thinking as easy as 1, 2, 3. So firstly, you would log on to your stockbroking BDA account if you have one. If you don't have one, you can open an account at any one of the online trading or ETF platforms. It's the likes of Easy Equities, ETF SA, Shift, etc. And then you really just search for those tickers. So 91D Inc. for our diversified income local income strategy, or 91G Inc. for our global diversified income strategy. And you kind of fund your trade, you buy, and off you go. You can invest for as little as close to 10 Rand a share. We listed at 10 Rand. It's gone up a little bit last night, but really it is as easy as that. And so I hope that investors come and experience the yields that are on offer. Our portfolio manager at yesterday's listing, said if you look around the world, typically bonds would, aim to pay you inflation plus compensate you for like the inflation risk premium. If you think about where our inflation is sitting, it's sitting at close to 3%. Look at the US, the UK, the Euro. Many of them are close to 3%. We are no longer an outlier at 6%. Their bonds are paying 4.5%. SA bonds are paying you 9%, right? So it really is the time to, come and experience those enhanced yields. Things are just going to get better after our constructive budget yesterday. It's a great place to be in the markets. And you've really got our fixed income team actively allocating between bonds when they're doing well and, kind of coming out of them when they not to preserve your capital. So really a great story. I'm going to invest personally.
I'm going to invest personally as well. I've got some cash. I've taken profits on a few platinum and gold trades this year, and I know exactly what I'm going to do with it now. CPI plus 6. You would be mad not to. Trinisha Chanka, thank you very much. Sales manager at 91. Thank you for taking us through a very exciting move that 91 is taking into actively managed ETFs. And I look forward to seeing what else you're going to be listing in the future. The listing went live on the JSE on the 12th of November, and it'll be very interesting to see how South African investors respond as this new wave of innovation helps increase our global exposures, our local exposures, and overall just our savings culture in South Africa, which we really need to do. Thanks for your time.
Thanks, Michael.